Hi traders, just wanted to take you through a few things today to give you some extra tools and extra confidence in your trading. When trading something like the pip runner, the concept is actually very similar to your 180 and your T-wave strategies. What I want you to make sure you're doing is looking for the structure on the higher time frame. And as an example, I'll take this Kiwi dollar chart versus the US dollar, and I'll just put a couple of circles in key areas. And the key areas we're interested in are anytime the market comes back to interact with the moving averages. Now, one could even add that area in, and this is the area that you would trade once you become better at reading price action. But I do want you to make sure the price is coming back to an area. Why this area? Because this is where the market is breathing in and breathing out. We don't know whether the market will bounce off a moving average. We don't know that. For example, look at this move here, off the 20, but it actually doesn't go very far. The good news for pip runner traders is you didn't even get a signal there because the yellow average, which is the 36 EMA, is below the 100. So that would have prevented you getting in. The key is to try and get in somewhere within this area. Once we've got this pullback and the market reverses, so you would like to see some sort of sign of reversal or looking for the pip runner. Look at this. There are no pip runners here. Is that okay? Of course it is. This yellow is below the blue, so there definitely would not be a signal. And in this area, there just happens to not be that entry there. So this fractal is slightly lower than that, and the signal did not go up on the following fractal. Therefore, the signal would have disappeared. But a few bars later, look what we get. We get some buy signals here, 2 buy signals, stop losses here, or use the advanced stop loss, and then the market goes in our direction. Now, something to add. When you see a trade go 90% within your take profit or to your take profit, you've got to ask yourself and discuss with your coach whether it makes sense to watch a price drop all the way back to stop you out. We know that it can happen, and it does happen. But when you've seen a trade go pretty much 90% in your favor, this trade would have not reached take profit simply because of the spread, which we've covered in a previous video. I would say if you're present, get your stop loss to break even and tell the market to do its worst. Because if you do the numbers, this trade has to move back pretty much 1% and another percent to take you out. Whereas you only need it to move 1 to 5 pips to take you out. We're talking 2.5 pips of spread there. So that's something, there's 2 things to contend with there. Timing of the pip runner and also breaking even when we get close to take profit. I'll give you another example, and you can do the pip runner on your commodities, you can do them on your indices. As long as you are following the rules, you can trade them on any asset. And we're looking for an asset to interact and touch an average. It's our key area. If you're not using averages, you're using Fibonacci's, you're using trend lines. Look at this. As if by magic, there are signals within these areas. Keep in mind the pip runner chart does not need to look as neat as the higher time frame. The higher time frame is where we get our direction. Once we've got that direction, we commit to being buyers or sellers, and you would have done so here, 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 and here. The signals in between are okay, but they're not as high quality as we look for. It's not about it winning or losing. Is the quality high enough? Do we want to get in mid-phase, or do we want to get in potentially at the start of a phase? Now, when you see where silver is today, we're in that exact location. Silver has generated a signal already, and these are losing. But that's okay, right? We've taken 1, 2, 3 winners and 1 loser. And that's a typical run of a trader's performance. So if you're present and you can be there, trade as often as you can, be selective, make sure you've got really obvious trends. And if the trends are not obvious, stay away. I'll see you next time, traders.